Hello everyone, it's me the Boss Hog, and we're back with another video on building wealth. Quite a lot to update on, not least because we haven't done one of these for 3 months. I also have a new camera, still messing around with the settings just a little bit. You're going to be able to see my beautiful face again as we talk through what's been happening over the last 3 months. Let's do it. Alright, and we are back. Sorry if that's disappointing considering I sold it as a beautiful face, but you're stuck with me now. In terms of updates, first of all then to this first overview. Actually, a few updates. First of all, I've changed the graph. Previously, it was our road to 5 million, but we were so modestly along that road that you could barely see the red line, and 5 million is sort of 2 decades into the future. So instead, I thought it'd be more interesting to look at this graph as we march toward 1 million, which we're due to hit by the end of 2027. We are basically on track at the moment, and following a pretty decent last couple of months. We're fractionally ahead, but honestly, broadly speaking, flat. We fell a little bit behind, not least because of the macroeconomic changes, etc., and a certain war. But since then, we've definitely been recovering, and honestly, I'm projecting a pretty decent increase from here. So maybe we'll be able to meet it even sooner. In terms of changes, you'll see a notable increase in the invested for both my pensions and my ISAs around May time. That's essentially because I put a big amount of money into my ISAs from a savings account that I had. And then I also sacrificed about 75% of my yearly bonus into my pensions just to try and avoid some tax on a 62% marginal rate. So that both of those things caused pretty big increases there in terms of invested. My other has also seen some pretty dramatic moves, and I'll explain why. Partly this is just sort of moving some money around, but it's also actually a reflection of the fact that trading 212 now allows me to move money in and out of my ISA in the same year. So in essence, even though I'm technically in a minus, I have access to 27 grand without accessing or impacting the tax wrap for previous years. So that change actually in my brokerage meant that I felt confident taking a fairly large sum of money, about 17 grand ahead of where I would typically be, and moving it from a savings account, which was other, into my ISA, which gets classed as stocks. So again, partly this is sort of paper and isn't something I'm particularly concerned about, but you'll see when we look at the breakdown that this has some interesting consequences at that kind of level. Similarly as well, in terms of the profit, it looks really weird in June. Again, I think we're just going to have to live with this for a few months whilst I move some relatively large sums of money around and then ultimately pay myself back over the rest of the tax year. So outside of that, significant year-on-year improvements. I mean, plus 40% is no joke. Quarter and month, etc., all moving in the right direction. It's very green. I'm broadly keeping up now with the S&P, having had a little bit more of a slow start to the year, slightly outperforming the FTSE 350 and slightly outperforming the All World. So, but slightly behind year to date the S&P, but not by much. And that essentially means that a lot of my wealth, which is exposed to the stock market, still a big majority of it, has been benefiting from what's a very friendly period at the moment. So significant improvements year on year. About 60% of that is additional contributions, and the other 40% is market improvements, if I was to try and percentage it for you. So this is the breakdown, and now we're going to explain a bit more detail as to how we got this breakdown. All right, so for anyone who's new here, I consider this more important, really, because this is the part of my investments that I can control. This is ultimately how much we are contributing to our own performance, not how much we're relying on the market. Now, last year we hit 77,000, just under there on the far right column. So this year I've been quite ambitious, aiming for 100. Again, this is ambitious. I won't be too disappointed if I don't get it. And I'm the kind of mindset that I would rather aim high and not waste money. And if I miss it by a little bit, I'm not going to beat myself up too much about it. You can see here that our target and how we're doing so far is pretty slow, considering this is halfway through the year. That was expected. Like my wife especially has a very commission heavy, shall we say, or bonus heavy allocation of her total package. Last year she got significant bonuses toward the end of the year. My assumption is something fairly similar this year, but we will see. And then we've also got things like school fees, tax bills, etc. And we also had a very nice holiday in April. So again, I'm not too disappointed so far. And if we project forward, I still would expect to make about 96k. Now, this is the first time that our expected target for the year has fallen below 100k. So I will be seeing if we can do something to improve this. But like I say, actually, we decided to be a little bit more frivolous in April. Spent like 2 weeks at a 5-star hotel in Portugal and had a really beautiful holiday. So decided to sort of treat ourselves a little bit, rather than sort of saving everything for the future. Like, these numbers are still really good and we're still hitting our targets. So I was a little bit more relaxed with our spending than typically I would be. But now, saying that, now that we've fallen a little bit below 100, I am starting to care a bit more, and we will hopefully do a bit better in the second half of the year, which was always expected. But now we just have a bit of catch up, essentially, as we go through the rest of the year. So my salary sack into my pension is now sorted. It eventually landed in May. Honestly, I think my company's mistake cost me about £500, just because there was sort of a market wobble when the original investment would have been made, and it was a 5-figure sum, so it was fairly significant, really frustrating. But at least that now landed in May. Basically, my company didn't put it into my wage slip, but also didn't put it into my pension pot. It just disappeared for a month. They admitted they made a mistake, and then they fixed it in May. On a smaller scale, my wife's payroll also made an error at exactly the same period. It's less obvious in these numbers, but that was about £500 where they basically used the wrong tax code when they made changes to her package, and etc. So that was also very frustrating, that both of our employers made mistakes at essentially the same time. You can see here our debt arbitrage remains relatively high, and the impact that this has in May is quite significant. You can see that uptick there. But again, this has all been factored into these numbers, so we're considering this is our sort of credit card arbitrage, as well as now sort of borrowing money from a savings account, which we'll detail a bit more just straight after this. So again, some of these numbers look a bit strange. Also, though, we have really focused on my wife's ISA, which 2 months into the year was already maxed out, and now we're starting to focus on my ISA as well. So that's also progressing pretty well. And again, the ISAs at the moment are a big focus for us. So I'm more than fine to catch up on other savings later parts of the year. And I'm broadly fine, other than the fact that we slipped just slightly behind on our fairly ambitious 100k target for the year. All right, so in terms of the promise breakdown here, the most important line is sort of 2 lines down from the bottom, actually. So mortgage offset account. The way to explain this is ultimately we have a savings account that's linked to our mortgage, and we pay less on our mortgage because we have this amount. Now, normally this amount is kind of rolled up into my home equity figure, but instead of sort of, it doesn't really sit in my home equity because I have instant access to it, but it also reduces the amount of my mortgage and basically looks like I pay a smaller mortgage by having it there. So I made the decision to move a significant amount of money from that offset account, and I did this for a couple of reasons. The first one was that I saw an opportunity to add it into my wife's ISA when a specific holding, specifically Allianz Technology Trust, had a little bit of a wobble, and I picked up like 15,000 or something in Allianz Technology Trust shares. That turned out to be a really good decision because I was buying those in the 355 range, and currently that's sitting at about 410. So I feel really good about that decision. That was definitely made me several £1,000s. And the second reason was because the offset account basically has an effective interest rate of about 5%. I don't pay any tax on it because of how it works. The savings are never technically paid to me. I just pay less on my mortgage. So I don't have any tax considerations, which is nice. But instead I decided to move a lot of it into premium bonds. Now, technically that's an incorrect decision, objectively speaking, because premium bonds pay a little over 4%. And I was getting a safe and guaranteed 5% on the mortgage. But the difference between the two was fairly modest. And frankly, I decided to sort of do a bit of a moonshoot. My thinking is that if the premium bonds, I do somehow win a significant amount of money, that's amazing. And I'm not ultimately going to miss what's a fairly small difference between the two, between the mortgage offset benefit and the premium bonds, if all things being equal. So it is a bit of a moonshoot. So those two factors combined basically meant that with the ability to sort of move and access money in Trading 212 in the same tax year, that I sort of still have access to it and I could make these decisions. So I decided, instead of making any change to the home equity line, which would look really strange, that I would create a separate, very transparent call out here but this is essentially borrowing money from myself. So it's like I say, it's just a paper line ultimately where I'm sort of moving it from one account to another. But it will be relatively important for me when I do come to remortgage next year to sort of pay this money back to myself, because that has impacts on things like my loan to value. And ultimately the rate I'm likely to get on my mortgage payments. So I will be paying this back over the next sort of 9 months or so. But for now, it's again deeply in the red. But again, just a paper transactional thing. So what this kind of meant is that again, the green bar here on the stat graph on the right is technically negative, but I'm not worried about that because again, I have access to sort of about 27,000 in my ISAs. That I can easily access, as well as the 46,000 in my premium bonds. So both of those things are pretty instant access, a couple of days to turn around. And so again, I have enough cover here for both my credit card arbitrage as well as the mortgage offset when and if it happens. So feel, again, very fine with the general direction here, and looking at the overall numbers, things are still moving in a really good direction. And yeah, plus 150 grand year on year, 40% as we touched on already. So that feels great. Other things to consider, I opened a new Lloyds bank account. I've only got £72 in there at the moment, which technically I put in 200 each month, and that's going to be enough to cover my council tax and my phone bill, my fibre bill for my flat. And that's just to get sort of a couple of direct debits so that when I start doing bank account switching, I have a couple of direct debits to move between each one. And then my credit card remains, I've got another 6 months or so at 0%, so it will remain there. The credit limit's 13.2k, and we typically tend to leave it about 12k. We sort of pay it down periodically and let it drift up. So I'm sort of just storing that there for reasons I've talked about before, formerly called stoozing. So I'm taking advantage of a 0% rate, as well as the impact of inflation ultimately reducing what I owe the bank when I have to pay them it back, or else pay commercial rates, which I'm not going to. I'm not going to pay 30% on that credit card. So when it comes due and the 0% falls off, I'll just pay it off and see if we can find another card or transfer the balance to another card depending on what's available. So this is the full breakdown. Again, we're really happy here, 541,000 broken down by these types, and you can see it sort of changing over the last year. And yeah, moving in the right direction as we sort of target 1 million in a few years' time. All right, so in terms of new capital added, again, the focus remains on the ISAs and the premium bonds. Premium bonds is sort of my emergency fund / covering any of my borrowing / moonshoots. So I like them. They're very tax efficient as well because there's no tax on it. And again, there's a very small chance of winning a fairly significant sum of money. We will see and keep our fingers crossed. ISAs I've spoken about before, and again, we're very happy with our progress year to date. So we'll adjust as the year goes on, but right now we're happy with those things. The other thing that's worth mentioning, and I think I might need to work out how to display this in terms of our capital contributions in the earlier information, but essentially I have had for basically since I started a holding in my general investment account in Trading 212, specifically in Games Workshop. And in the early days, this was kind of an intermediate emergency fund where it wasn't in my ISAs, and I could access it worst case scenario if I needed to get access to 3.5 plus K. But that's not really how I'm doing an emergency fund, and it isn't really good advice to have your emergency fund in stocks. But I was very new, getting up and running, etc. So it's fine. But I've kept it there for a long time because my wife works in private equity and I have restrictive trading. I didn't want to sell it and then rebuy it because actually I'm not allowed to buy individual shares. And I thought this was really annoying. Games Workshop also sort of pay me dividends equivalent to almost £500 a year. And I didn't want to run into the issue where, at £500, I was potentially going to have to pay savings taxes and things like that, because again, the government has reduced the rate that starts on. So I emailed my wife's employer and basically said, can I do a transfer, right? There's no formal transfer mechanism. Can I sell and rebuy on the same day, move the money into my ISA? Got authorization that yes, I could do that. So I did do that. And essentially what that means is I sold my GAW Games Workshop position in my GIA, then moved 3.7k from my GIA into my ISA, and then rebought 35 shares in Games Workshop. So a little bit of transaction fees I wouldn't have otherwise had to pay, but honestly, a couple of quid in the scheme of things is absolutely fine. So that's partly why in June you can see there's 7731 in my Trading 212 shares. That's 4,000 in terms of new capital, and then the Games Workshop shares transferred into that. We added some premium bonds. That was actually an unexpected win. I didn't really expect to add 2.5 grand in premium bonds in June. However, I had a really great casino session where I won 2.5 grand, and I was like, well, I wasn't expecting to have this money. Let's put this money into premium bonds. So that's exactly what I did. But then my cash savings here shows minus 3.8, and most of that is again related to the movement that I had for Games Workshop. That's basically moved, right, just because of how the account is allocated. It's not an ISA ultimately, so it was being classed as cash savings for the purposes of this. And then withdrawn here. Sorry, I just realized I made a mistake. So the withdrawn here is 3.7, and then the cash savings is again movements that I've made from my offset account into the premium bonds, as well as the ISAs there as well. So sorry about that, that's my mistake. But yeah, overall what this means is that we are contributing year to date a little bit. Probably not as much as I would have liked, but again, most of the focus, we did the salary sack, which previously I hadn't done in other years, which overall is a better net position. And then, as we've already touched on, we haven't quite been as ambitious with our savings because we've started to relax in our spending. Nothing more to add there, and yeah, everything here is what I've already spoken about. So I'm just going to round out with the things that we have left to do for 2024. All right, so 2024, some wins. So we've reviewed Wife's pension contributions for her new salary. That's looking good. So we haven't yet done our junior ISA transfer. It's all very manual, and I haven't got around to doing it yet. Originally, I tried to do this in February, and it failed because of the difference between a 5 and an S in the account reference, and the fact that everything with Hargreaves Lansdowne has to be done by paper, which is ridiculous. But it is still 0% fees, which will make it worthwhile eventually. So I need to get around to doing that. We completed our ISAs for last tax year, and now obviously we're working on our ISAs for this year. I did do a review of our pensions in Nutmeg, so this is where me and my wife have our consolidated pensions. Certainly for me, it will make sense to move away from Nutmeg. I can get better deals elsewhere. I did consider moving to Vanguard, but actually decided to cancel that. And now I'm waiting to see what the offer and what the options are with trading 212 before making a decision. My wife's Nutmeg account technically is still very good with Nutmeg in terms of the fees. What I would say is that both our Nutmeg accounts are, in my opinion, very risk adverse. But they're already set to the highest risk tolerance that Nutmeg allow. I did actually send them an email to say, is there anything more sexy than 15% holding in the UK and another 15% in ESG funds that I don't really believe in anyway? And they were like, no, sorry, that's as risky as we can make it. So that was a bit disappointing. And ultimately, I would say that Nutmeg in the long term doesn't fit my particular investing style. So we will be looking to move away from Nutmeg. We will be seeing what Trading 212 have. Depending on that, we may well move to Trading 212 for the pensions. If not, then we will shop around, potentially considering something like Vanguard, or maybe where we have a bit more options around our risk, like Standard Life or somebody like that. But we will see. Emergency fund is in progress. Everything feels quite messy at the moment where I've made the decision to move money around, so I need to think about how to present this. Probably something like, the debt figures and then plus the money that we've got and then what's actually left over. That's probably going to be the equivalent of an emergency fund. Again, here 35k, to be clear, is just a target. It's not going to be too disappointing for me if it's 20 or 25. The reason for 35k is that's slightly over 6 months worth of cost for my wife and me. So I would say that would be sufficient for just about anything we can think of. So, if it's only 20 grand, it's going to cover us for like 4 months. It wouldn't be so bad. And that would also assume that both of us lost our jobs and both of us couldn't work for any reason, right? The chances are that one of us would be able to bring in some money, but still it would be nice to have that emergency fund, and that remains a target for the year. And then lastly here, the 100k that we spoke about. So I haven't added any new ones to this just yet. We will be needing to do our tax bills fairly soon before we're late. So I suppose I could think about adding them for next month and give you an update. I do expect both of them will be in the low 4 figures, but we will get an update from HMRC when we get around to doing it. So those are the things so far that I've either done or to do for 2024. And generally speaking, other than sort of me complicating the video and some of the tables here, things are again continue to move in a really good direction, especially now we are back ahead of the curve and on the road to 1 million over the next few years and then 5 million over the next couple of decades. So this is the update. It's very warm in here, by the way. Sorry for my sorry for that. I sort of closed all the windows because my sensitivity on some of the recording equipment seems off. But now I've just baked myself alive. But anyway, I really wanted to do one of these. These are probably my favourite videos. Very fulfilling to do. So hopefully they're also interesting. Thank you very much for anyone, especially those of you who stuck to the end. I've been the Boss Hog, and good luck with your wealth building. Bye for now, everyone.